The discussion between fundamental and technical analysis rages on. This debate, let's settle this once and for all for our audience here with our next guests, Patrick Karim and Kevin Wadsworth, expert technical traders at Northstar and Badcharts. Welcome back to the show, gentlemen.
It's great to see you again, David. How you doing?
Yes, thanks, David. It's always a pleasure.
Always a pleasure to have you guys. You're one of my first interviews of the year. We're going to be going over your outlook for Bitcoin, stocks, and gold. Very exciting episode, very important episode because you're setting the stage for the entire year for our audience here. We'll be talking about exactly how you've come to your conclusions. And of course, towards the end of the interview, we'll give the conclusions themselves, your outlook. So stay tuned and watch until the end. Now, I want to talk about some data that came out today, and I want to just ask you why the markets are reacting the way they are to certain data releases. So as you know, ADP data came out. So U.S. private payrolls, I'm just going to read a paragraph from this Reuters article. U.S. private payrolls increased by more than expected in December, pointing to still strong demand for labor despite higher interest rates. Private employment increased by 235 jobs last month, the ADP National Employment Report showed on Thursday. Data for November was unrevised, and economists polled by Reuters have forecast private jobs increasing by only 150,000. So we had more people employed last month in December than the consensus estimates. Interestingly, all markets are down today. I don't know if this is a reaction to that data release or perhaps it was overbought yesterday. You'll recall the day before everything was up. Stock markets, S&P 500 is down by 1.2%. Gold is down by 1.2%, which is a big day for gold. The Nasdaq's down even more. Bitcoin is slightly flat. So let's start with Patrick. I'll let you comment on market moves from the day and what it is you think that it was reacting to.
Right. Well, this is step number one, guys. The daily price action will get you in so much trouble. So if you're an investor, a day trader, or if you're trying to react to this daily volatility, it's like, I pray that you have so much emotional capital for those whipsaws, because we know, looking at charts, Kevin and I on the daily chart, because go up crazy, crazy down. And after that, what you thought was moving the price on Friday was something totally different on Monday. So you got to take a step back, let the capital flows. So that's major asset classes fighting on the higher timeframes for that M2 money supply, for the money supply. So it's the SPX versus gold chart. So whatever happened right now, the news release, the market reaction, you know how it is. You could flip flop it. The price could have went up today, and after it would have been the same news. So you gotta let the market do its thing. The market participants absorb that, aggregate that information with all the previous aggregate like fundamentals, all that stuff piled up in there, discounted for the future. So it's super complicated. If you really go down, try to see why it's moving today. But I do have a chart, and I know that's not part of the data that came out today for the initial claims. So the US initial claims data, when that breaks out, right now it's practically at all-time lows, hogging the bottom rail. When that breaks up to the upside, that has some mathematical, scientific evidence with, I could overlay the gold to SPX charts. When that explodes to the upside, initial claims, something happens in the macro tidal wave flows, which is going to favor capital flows going to gold. And that could probably lead to when we talk about our gold projections, and leaves the SPX. So that's what I'm looking for in those metrics that really seem to react to the market, that maybe the OFMC, they're looking at initial claims more than this ADP report. That's what I'm looking at. But for right now, whatever happened today, on the daily price action, I think that's a sideshow compared to the real moves that are unfolding before our eyes there on the higher time frames.
Is a long-term correlation. Let's talk about that. Let's go over that chart later. But Kevin, I want to move on to you and talk about just building on what Patrick said earlier, how to trade noise. I mean, you wake up on any given day, there could be news out of the left field, moving prices in either direction. A lot of investors or traders who are just starting out will look at this data and start to panic or perhaps make moves that they otherwise wouldn't on a calm day. Now, there's nothing wrong with trading volatility. The question is just how, and of course, how you should react to noise and news. I'll let you answer that.
Nothing wrong with trading volatility, but I try to avoid it to a large degree.
Okay.
It is a lot of noise, and if you step back and look at the bigger picture from a bit more of a bird's eye view, you can put the whole thing in context. So this is where the big debate around fundamentals and narratives versus technical chart trading comes to the fore, really, because there's a lot of stuff going on. As Patrick said, you can spend countless hours trying to work out what it is that's moving the market. Really, my question to you and to the viewers is, who cares? I don't care. Do you care, Patrick? You don't care what's moving the market. What you care is that the market is moving.
Wait a minute, guys. Wait a minute. You care if you lose money, though. I mean, markets are down.
What I'm saying is I don't care why the market is moving in
all right.
a particular direction. The market is moving up, it's moving down, it's moving sideways all the time. And yes, we'll care about that. But what is actually causing the market moves? As Patrick said, you can spin a narrative on one particular day, the market's going up, and another particular day, the market's going down. For example, the fundamentals behind Bitcoin, they haven't changed. Bitcoin is still, as good a proposition as it was, 18 months ago, 2 years ago. Bitcoin's fundamentals, its possible role in the future of sound money, if you're of that particular view, that hasn't changed. And yet Bitcoin and cryptos generally have fallen 60, 70, 80, 90%. Many have fallen 100% and don't exist anymore. So what's causing it? It's not the changing fundamentals in particular of crypto or of any particular mining stock or any particular tech stock. It's not that's moving the market. It's these huge, massive shifts in capital that are taking place, these tidal waves of capital flows that take place on a regular cyclical basis. And you have to spot and manage and notice these huge tidal waves of capital flows. And with that information behind you, by using ratio charts, by using technical analysis, you really only need 2 or 3 lines on a chart, David. I could show you a couple of lines on a chart that would completely cut through today's noise. Has it crossed a key resistance level, key support level? If it hasn't, then it's just noise. It's just stuff that is going on in the general direction of the trend.
All right, we're going to, one more question on this topic, on this debate, so to speak, and then we'll move on to your actual market outlook. All right, there's nobody here to debate both of you, so I'm going to have to play the part. You're both technical analysts, so I'm just playing the part here. A fundamentalist might ask you, and whoever wants to answer this question can take this. A fundamentalist might ask that whether or not it's important to look at the past, and his answer might be yes, because he might say, without examining and understanding why things have moved, you will not be adequately positioned or prepared for positioning yourself on a trade next time that same thing happens, right?
Doesn't matter. Makes no difference. That makes absolutely no difference whatsoever. But it's two sides of the same coin. So I'm not anti, and I think Patrick's the same here. We're not per se anti-fundamentals. The fundamentals are there, they're in the background. It's part of what is, building that history that you speak of. But until or unless those fundamentals and all of that history and all of that stuff, until or unless that actually moves the price chart beyond a particular breakout level, where there's a technical breakout, where we can all recognize that there's a build of momentum and that it's crossed a line and that we're now trending into a bull market, and all of these things that need to happen, getting above key moving averages, the 30-week moving average, the 12-month moving average, the downtrending breakout line, getting above the volume node. Those things, when they happen, then that's significant. That's the only thing that's significant. That's the only thing that matters, because you're not trading the fundamentals. If you trade the fundamentals, you would probably have bought uranium miners about 4 years before they actually broke out. So you're right about the story. You're wrong about the timing. The charts bring you the timing. They show you when to buy. They show you when that level's crossed. I can see Patrick's wanting to say something.
Well, because the way I see it is, let's say you have a layers. What you trade, what people actually make money on is price moving from 100 to 200. You make money on that. So if you study price, guys, if you study price, you're at the closest to the epicenter of you getting money. If you're studying fundamentals, the fundamentals aren't moving the price. The price is moving the fundamentals, because CEOs will react based on the price of their stock, whatever. They'll invest more. The capital flows driving the price. So if you're studying fundamentals, for me, you're just one layer ahead. So skip all that minutia. I know, because I understand people. I try to put myself in the feet of people like who learn fundamentals. I learned fundamentals before I did it, chart trading, because as humans, we love stories, words, they mean to us. So it's easy to anchor to a story or fundamentals. Analytics, it's not everybody that's like me and Kevin. Of course, anybody could learn chart trading, but it's not, we're not taught that at school. It's not instinctive. So in the media, it's always after that people talk about chart trading, but essentially chart trading is way closer to you making money than fundamentals because it's just you're studying the actual price. So the stories, whatever fundamental, the metrics, they're always going to be layers because even if you believe in a fundamental, Warren Buffett, great fundamental in Coca-Cola, whatever,
right,
the price still has to agree with his fundamentals. So that's like the way I see it.
Everybody loves a good story. You know, if you can put it into words and make it sound good and convincing, everybody anchors onto that. If you show them a chart with some squiggly lines on it, it's like, oh no, I don't understand that. I'm gonna, it's garbage. It's kind of it's voodoo. It doesn't make sense.
So you believe
it's that reaction.
You believe that markets are fully efficient. In other words, they price in all available information to the public.
Yes, because you have no choice to think that. And even if they didn't, it's still the price that you trade. So you have no choice than study what the price is doing. And the price, essentially, it's human greed and fear cycles repeating over and over. So even if the markets weren't efficient, you're still trading the price, right? You have no choice.
The markets are known to be a leading indicator for the economy for various economic aspects. Can you give us just one example of when the price has actually led an economic development, whether it be inflation, whether it be an economic recession or economic rebound, whatever the case may be, has a particular asset?
And a perfect example of that is the so-called the energy crisis.
Okay.
So the price started moving on energy in Europe. When was it? It would have been late 2021. And I started to point out, you can go back through my Twitter feed. I'm posting stuff all over Twitter saying, why is nobody talking about this? The price has broken out. The gas prices, natural gas and the electricity prices, right the way across the continent of Europe, Germany, Italy, France, UK, Belgium, Holland, all of these countries, prices breaking out. But because it's just crossing a breakout line, nobody's interested. There's no story in that. Show a newspaper editor a line on the chart and say to him, "Oh look, the price is breaking out. It's a historic breakout. That line has been there and it hasn't broken out above it for 30, 40 years." He's going to look at that line on the chart and say, "Well, there's no story there." And so I track this month after month after month, saying all over Twitter, why is the media not talking about this? Prices are now double what they historically were. They're triple what they historically were. They're 4 times what they historically were. And then the war broke out. Russia invades Ukraine. And then suddenly the energy is because of the Russia-Ukraine conflict. Absolute garbage. Complete and utter garbage. The price broke out many, 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 many months before any military action took place. So that is a classic example of a narrative and a fundamental story. Everyone's got it in their heads. Energy prices went up because of the war. No, they didn't. Why did they go up? They went up because of terrible, terrible, terrible planning and energy policy by the governments of Europe. So everything was already going very badly wrong long before the war broke out.
There's just a small thing. Gold broke out in June of 2019. Inflation was actually going down while gold was going up. It was sniffing monetary imbalances, the incoming inflation, or it's more destruction of U.S. purchasing power that gold tracks inversely. It was breaking out ahead of time. So if you were waiting for CPI to break out, or you're too late, gold had already moved from 1100 all the way to 13, 14, 15, 1600 before people start talking about gold. And you know how it is. People talk, it comes to the media attention because it went up 100%. It went up 10,000%. But the move's done, guys. The breakout, we spot like it happened a year before.
The British pound against the US dollar, the moment it hits its bottom, when our Prime Minister here makes all sorts of mistakes, it's all over the press. Everyone's talking about it. The pound is, is finished. The pound is finished.
Fantastic points.
I went to social media. I said, that's it. The pound is hit its bottom. It's going up. The euro is going up, and people putting on Twitter, why is the euro going to go up against the dollar? Why is the pound going to go up against the dollar? The garbage. And I'm like, well, because the chart says so. It's hit the support line. It's hit the newspaper headlines. Everyone's talking about it. That is the classic point at which you need to go long. And what happened?
You both of you have made, that's probably the most important point so far of the interview that you've made is look at the charts, look at the prices. I tell this to my friends all the time. They ask me, why did gold go up in March? Because, how much impact did the Ukraine war have on the gold price afterward? Well, if you look at the charts, gold was moving up in January and February into the war. It was already moving up. So maybe it's contributed somewhat. maybe it's had a momentary spike. Of course, we could say that it had some impact, but you can't say that gold moved up this year because of the Ukraine war.
Right.
Well,
it was already moving up. Yeah.
In that particular instance, David, it was in fact gold has built a cup shape on its chart over 10 years or more, and what we've been seeing over the last 2 years is a handle forming. So the handle was going down on the price chart. It's a very classic technical analysis pattern, and that handle was already being put in place. The war broke out and price spiked up. It spiked up out of the handle, and then it's come back down into the handle. And for the last year, it's carried on building that handle. So that handle on the gold chart, that very classic technical analysis pattern that we already previously identified, was already in place. The war spiked it out of there, and then it went back in to finish doing what gold was already predestined to do. It's not until you get the genuine breakout, and we're getting close to that, when gold breaks out versus SPX, that's when we can start to say that something major has changed.
All right, gentlemen, so let's talk about, perfect segue, let's talk about your gold outlook then. So Kevin, you were already talking about your cup and handle pattern, so let's continue with that and extend that analysis into the rest of the year.
Okay, well, short-term target has to be around about the 1915, 1920 area. There's some downside support on the 3-year moving average. I think it's around about 1800. And there's an arc pattern in place. If you're not familiar with what an arc pattern is, then take a look at our social media. You'll soon find out. But basically around about 1745. So we've got a couple of downside support levels in downside scenarios. If gold does not break out versus SPX, and I'll keep saying this, gold versus SPX needs to break out, and it needs to get above 50% of the SPX. If gold can get a valuation of 50% of the SPX on a monthly closing basis, then we can heave a sigh of relief and say that gold is on its way to a long-term bull market, and that any pullbacks will be relatively short-term, and we're just going to keep this trend upwards as we did in the early 2000s. So if we can get above if we can turn 1915, 1920 into support instead of resistance, if we can turn it into support, then the floodgates open, and we can see gold moving up to $2,500, $3,000 within the next 12 to 18 months. So that is the roadmap. If we don't see gold breaking out versus SPX, that whole process is on hold. So it all hinges on those capital flows. If those capital flows confirm it, okay, $2,500 to $3,000 next 12 to 18 months.
Patrick, let's move on and discuss that with you now. Let's just follow up on what Kevin said. So suppose that we have 50% gold versus SPX ratio. Could that just not mean that the XPX has been, that the S&P 500 has been falling, and gold is just, relatively speaking, it's flat? Would that still be bullish for gold in that scenario?
Well, yes. So if you zoom out, a lot of people brought that because, of course, that's a good point. Ratio charts, right? It could go up while the price of both instruments going down, right? But what we've seen over the long term is when there's a high correlation, a positive correlation with the gold to SPX ratio with the actual gold price. So that's where our confidence level, it's not just looking at a ratio and we don't know which one's moving what. If I would overlay the gold chart, or in particular the silver chart, and that's how, let's say capital flows are defined by gold divided by SPX. If I overlay practically any minor chart, the silver chart, uranium chart, the oil chart, all these instruments, they track how much money gold is able to extract from US equities. So they have positive correlations to that ratio. So if we move up to what's happening actually right now is SPX has been going down, gold flat for the past year, right? SPX, and that ratio stayed flat, but it actually went up in favor of gold, while gold did not go up as much as we thought. But once it breaks above .50, and there's a positive trend on the monthly chart above its 1-year moving average, above its 3-year moving average. If you take a step back, you'll see that gold's price is tracking that. It's gold's price moving that ratio chart upwards with a combination of SPX going sideways, down. But often what people don't realize is gold and silver will go up. Once SPX is broken down versus PPI, the gold to SPX ratio will go up, with US equities possibly also going up. But it's just that gold is pricing in so much US purchasing power destruction that is required to keep nominally afloat the US equities. Gold is pricing all that in, and it's outperforming the SPX. And that's why, guys, it's important. At this stage right now, you have to stop measuring everything in fiat. I know in nominal terms, but because SPX has broken down versus PPI, you have to start measuring everything in gold or in silver. Divide So if your instrument is not able to outperform gold or silver, you even if there's a super bear market rally for Bitcoin, for Nasdaq, it's going to happen. If on that rally up, silver is outperforming your tech stock, that's a very bad sign for whatever you're trying to play on the growth side.
Okay, just to follow up, Patrick. So Kevin already gave his upside target. Give us your, I don't want to say downside target, but because perhaps you're not bearish, but a support level on the downside that may worry you. Suppose that level were broken on the downside and we could see more downside for gold. What level would that be?
Well, right now we're back above a wall on the monthly chart that was 1720, 1725. If ever we're not able to get out above the levels that Kevin identified and we start climbing back down below the 1 year, below the 3 moving average, any close below 1720, and you could have a fast fall to 1675. And if ever we go below 1675, then we're in big trouble, because then we could go all the way back to, it can melt down to 1550. And this people have to remember, if ever you want to know how fast a stock or an instrument could go down once it starts faltering from a topping pattern, it's going to go down as fast as it went up. So if gold went up fast from June 2019 all the way to August of 2020, when it skyrocketed up, if ever that topping pattern is not a continuation pattern, it could fall really, really fast to 1550, 1300. But we're not there yet. Okay. But if you want to see gold never close below 1700 there, you don't want to see it go back there. That's a big bad sign. All right.
Let's watch out for that. Let's move on to Bitcoin now. I will bring up that 7 months ago, exactly on May 9th, we spoke about Bitcoin. And on that day, Bitcoin was trading at $30,000 US. And you had told me, both of you were on, you had told me that Bitcoin's crash wouldn't stop until it reaches $20,000 on the downside. So that was the correct call. So, bold call. You call for basically another 33% correction. So that's 10,000 on 30,000. We've actually broken below 20,000 ever since it came down to $20,000 in June 2022. So June of last year, it's been trading within a range. I'll just let you explain the pattern that we've seen over the last 6 months and just describe in technical terms what Bitcoin has been doing for the second half of 2022. Whoever wants to take this.
So Bitcoin remains in a defined bear market at the moment. It's actually doing some things that it's never done before, which is a little bit worrying. And you have to set Bitcoin's price action against what we've just been talking about. We've been talking about general equities, about the SPX. SPX and Nasdaq are breaking down versus inflation, or have broken down versus inflation. That's only happened 3 times in the last 100 years. So to make assumptions about Bitcoin and Bitcoin cycles based on what has happened since 2011, 2012, 2013, when cryptos started to come to the fore, you're making a huge leap of faith there, setting it against the current macroeconomic environment. We can't take it for granted. Cryptos are going to do the same as what they've done before. So having said that, Bitcoin does remain in a defined bear market. It's below its 30-week moving average, which I think off the top of my head is somewhere close to 20,000 now. In fact, I think it's a little bit below 20,000 US. I would not touch Bitcoin until it gets above its 30-week moving average, and until it gets above some key horizontal overhead resistance levels. But that area around 20,000, I wouldn't touch it till it gets above that. In terms of the downside and where it might go, when we last spoke, I spoke about the lower probability outcome of seeing Bitcoin getting down to 10, 12,000, that kind of area. And that certainly remains on the table. As long as we're below the declining 200-day or 30-week moving average, Bitcoin could quite possibly plunge the depths of 10, 12,000, conceivably even a little lower. Mm-hmm. I'm not going to take that off the table either. So I'm not going to sit here and say Bitcoin is going down to 4 figures, but it's certainly not impossible. I'll probably rate that at about a 20% probability, something like that. It's a low probability, but it's not a probability that you would want to disregard. And in terms of dollar cost averaging and that kind of methodology, I just don't see the point, because you're buying, you're just buying in a bear market. Why buy anything in a bear market? I just don't get that that whole idea about sort of buying all the way down, particularly when you just don't know how many months or even years it might be before you get back to to new nominal highs. So
Yes.
yeah,
I'll tell you why, Kevin. I'll tell you why the people are buying in the bear market rally. Can I, David, do this part?
Please, go ahead.
Because people love stories. The Bitcoin story was so powerful. I don't want to name names. You guys, you know who you are. It was so powerful that people feel attached. There's one ticker. They could only trade that, and they're stuck. Guys, with chart trading, I don't care what the ticker is. There's millions of tickers. Like, you could choose, guys, the best looking charts. You should be choosing stuff that nobody's talking about. Bitcoin, we've talked about it to death. And that's why people try to keep catching these bear market rallies. Guys, please don't do that.
I feel like this is a very passionate issue for you. All right. Why don't you, all right, Patrick, you know what? I'm not going to stop you. Keep going. Tell the audience directly what you should and should not be doing right now in regards to Bitcoin. Please continue.
Okay. It's Bitcoin, guys, but it could be for NASDAQ, growth stocks. Right now, the macro landscape is that any nominal rally in tech stocks, in Bitcoin, it's their bear market rallies. Because SPX has broken down versus a producer price index, you're in a bad landscape. And like Kevin described, as long as you're below that the 3-year moving average, or at least even the 1-year moving average, that's the market. The outflows are leaving Bitcoin. Even if there's only 21 million of them, there's so much money leaving there that who cares about the supply, that it's finite and there's no more. The price is going down. The market is telling you, market participants are telling you that there's no more momentum going upwards. So wait until this thing bases. And once it creates a beautiful base, there'll be a beautiful breakout line and we'll go long again, just like we were long cryptos back in 2020. We were long Ether.
Yeah, don't get the idea that we're anti.
We were long Bitcoin.
Literally cover up the ticker in the top left-hand corner of the chart. We don't care what the ticker is. It can be Bitcoin. It can be bananas. We don't care. We treat every chart exactly the same set of rules. Remove emotion. If you've got emotion involved in your trading, then
just on that point that you just made, there's a game online. It's called Chart Game. We're not going to play it today because I don't have my equipment set up to show you live. But you know, it basically there's no ticker. You don't see what the stock is, but it's an actual stock, and it shows you an actual point in history. And then you just trade up and down. The only thing you can do is buy, sell, and hold. And the only decision you can, the only information you have is the previous day's price pattern. And then, you know, you play the game and it tells you how much you've made or lost, and then they'll give you the actual ticker towards after the game is after the game is done. Chartgame.com, check it out. It's a lot of fun. But but to your point, the chart tells you that there's no bullish momentum right now. Fair enough. Have we been in a consolidation pattern already? I mean, it's been 6 months since Bitcoin's been in a range, right? I'll let you answer that question. Yeah.
Let me try, Kev.
Well, all I was going to say there is it very well may be. It just needs to prove it to us. And it proves it in the same way that every chart proves it. It gets above its key defining moving average that has defined the bear market. With Bitcoin and most cryptos, you're talking about the 30-week moving average. It needs to get above what we call the wake-up line, which is the downtrending resistance line. And it needs to get above the overhead key horizontal resistance level. Once it's done that, once it's done just a handful of things for us, then the evidence will be in place that a base has built and that the price is now likely to do something more constructive. Until it does that, and it's done none of those things, it hasn't done any of those, not one of them. So I'm not touching, Bitcoin with a 10-foot pole.
Yeah, and this is a key element. Everything is defined by time frame. Even somebody's opinion, right? Oh, I think it's going to moon. But like your good questions, well, when? You need a time frame. So even if I zoom out on the monthly chart, which is a hybrid time frame, it's not too short to have the whipsaws, and it's not too long to say, okay, well, it's such a long period. Bitcoin has just broken down 6 months ago, and then it's consolidating, sloping downwards. It's drooping downwards. There's even on the monthly chart, there's no bullish momentum at all.
I think this is the start of a joke. Two guys walk into a bar, a fundamentalist and a technical analyst. The bartender says Bitcoin's going to the moon. The chartist says when, and the fundamentalist asks how.
That is so funny.
That's got to be the most boring joke in history.
Well, don't worry about it. You don't have to laugh. Okay. Anyway, let's move on. I thought it was going
to turn into a rude joke there for a minute, but
the question of when is very important. Of course, nobody has a crystal ball. What would you say to this rebuttal that, guys, you don't have a crystal ball, you don't know when? Why bother asking yourself when? How would you respond to that?
it's about probabilities. And they're right. And this is the problem with people who say it's a certainty. There's no certainties. We're just playing probabilities based on past evidence. And then we've seen every time we've had this pattern in these circumstances, this was the result. 4 times out of 5, it reached its target. 1 times out of 5, it went down. That's how, and when we see these patterns, then we have a sampling rate because we're looking across a plethora of stocks, a plethora of ratios on different timeframes. Because we've spent tens of thousands of hours looking at these charts, and other chart traders for 100 years, we've learned from them. We're able to establish actual probabilities. Okay, this is a setup. Like Kevin named all these technical clues we're looking for. That's it. I have a 4 chance out of 5 to reaching my target.
Okay.
The Kizunio is not going to give you those odds. This is not flipping a coin. This is 80% chance that I'll actually make money and reach my target.
And something else. Do you know what? You only need to be right 1 time out of every 3 or 4. And if you're doing it properly, using proper risk management, just getting it right 1 time out of 3 or 4, after a 12-month period, you can see your NAV gain by a significant amount, because by using those probabilities, you're able to identify the moves or the chart setups that have the greatest chance of success.
Right.
So you take a larger position size on the ones with a greater weight of evidence behind them. The ones with a smaller weight of evidence, smaller position size, those are the ones that you get triggered out of. And this is shown, we have evidence to show this. You get triggered out of the ones with a smaller weight of evidence. Happens over and over and over again. Hits your stop loss. You only need a smaller number of the high evidence ones to succeed. And by doing it, if you're doing it properly, you actually don't need to get very many of your stock picks right. And that's something that a lot of traders sort of seem to fail to grasp.
So Patrick, do you agree with Kevin's downside target, the bottom for Bitcoin?
Well, there's a huge wall at 10,000 to 12,000. So like the markets, it's not hard walls. It's like you have to see that as a sponge. There's huge volume there. So Bitcoin could maybe on the smaller time frames hit 4 digits, maybe, but there's a massive wall right there at in between 10 and 12. So whatever it lands there, the market's going to tell us if it goes sideways and it's able to create a base above that that wall at 10 to 12 to 10,000. That's perfect. It could create a setup for it to actually explode and try to go back to all-time highs.
I mean, a little bit like everyone was looking for Bitcoin to go to 100,000 and it didn't. Of course, everyone probably has spotted the 10 to 12 zone, and I suppose a lot of people are expecting that. So it may very well not do that, which is why it's important to be able to spot the breakout, spot the evidence, and act quickly. If and when that evidence comes in, just because that strong level of support is there. Doesn't necessarily, and it's a nice round number, 10,000. Everybody loves a round number. I suppose 9 times out of 10, it just doesn't work out that way, which is why the technical analysis is so, essential, really, because it really does 2 or 3 lines on the chart. It kind of tells you pretty much everything you need to know.
Okay, we're going to close off on a speed round. So you each have 30 seconds or less. Just answer this question. I'll start with Patrick. So I'll ask you both the same question. So Patrick, SPY, so S&P 500, Bitcoin or gold, which of these have the highest growth potential in 2023 and why?
Definitely gold. And why? Because of the SPX breaking down versus producer price index, because the NASDAQ has broken down versus silver versus gold, because Bitcoin has broken down versus practically all commodities, oil, silver, gold. The odds are now that gold will, if it goes sideways, it'll still outperform SPX and Bitcoin. And if it goes up, it's probably going to be on a rally on the SPX, but it's going to outperform anything that's growth, tech stock and Bitcoin. So definitely, if I had to put my money again, it'd be on gold. Okay. But again, gold has to break out versus SPX. So the odds of my forecast increasing will be if we'd be talking today and gold was worth at least half of SPX, my conviction level would be even higher than it is right now. But from all the evidence we've gathered, this is the roadmap. We're heading for a better year in gold than outperforming all those instruments you named me.
Kevin, similar question. I'll expand that. What will be the best asset of 2023? Could be anything. And why?
I was going to say what he said, but you've opened up the whole Pandora's box.
No, that would make it too easy.
Precious metals do look poised to perform very, very strongly. So silver may just edge it again. It's worth noting that gold was broadly flat in 2022. Silver was up around 5%, I think. Silver may well continue to slightly outperform gold. So it's kind of between those two. The miners, you got to give an honourable mention to the miners, because they are so beaten down. At some point, they are going to rip your face off, I think. But whether it does that this year or whether it takes another sort of year, 18 months beyond that to take place, but the miners could very well move. Keep an eye on SIL, SALJ, GDX, GDXJ. But okay, I'll say silver. Pat's gone for gold. My money's on the silver horse.
All right, great.
I wasn't able to choose silver, Kevin. It wasn't any of my choices.
Too bad. I've got silver anyway.
No, it was two slightly different questions. So it was gold versus SPX versus Bitcoin. You think gold would outperform the other two, and Kevin, you think that silver would be the outperformer versus everything else. Final question, not to do with the markets, but you guys are great business partners. You work together, you collaborate great. But you're two individuals. You must have differences of opinion sometimes. How do you resolve differences in views? Let's say you think Bitcoin's going to go up. Kevin thinks Bitcoin's going to go down. How do you talk it out?
Well, I'm right every time, of course.
Oh man. Okay, all right. That's how you want to answer.
I'll leave. I'll let you guys duke it out. No, I'm kidding.
We have differences of opinion. We talk it out. It's a discussion. We as we've said, we've tried to give an overall view in this interview of just how many moving parts there are to what's going on with gold, with silver, with the S&P. You have to look at this broad jigsaw puzzle, this broad whole load of evidence. It's like trying to figure out a murder scene. You've got blood stain over there, you've got a knife over there, or a gun, or whatever. You're trying to put all these. You've got a dead body over there, whatever it happens to be. You're trying to work out what the hell happened and what's causing it. And there's all these bits and pieces to bring together. And so when me and Pat have a difference of opinion, we have a Zoom call like this, and we spend a lot of time talking about it. Sometimes we end up agreeing. Other times we just sort of have slightly different views on what might be going on, but that's fine, because as Pat said a minute ago, it's not about certainty, it's about probability. So Pat might be thinking that the probability for event A is slightly higher than for event B, and I might have it slightly the other way around. That's fine, as long as we both acknowledge, and as long as everybody watching this acknowledges that there are lots of other possible outcomes.
Yes,
gold could go to $900. In my mind, it's a tiny probability, maybe 0.5%, but it's a possibility. So gold could go to $5,000 in the next 6 months, but again, very, very tiny possibility. So everything falls within a range, and that's the way we approach it. It's a weight of evidence.
I use your technique. I do the devil's advocate, David, and even if I agree with Kevin, I do the counter argument to try to break his thesis. Well, but Kevin, didn't you notice? Look, that it's below its 12-month average. Are you sure about that? And I challenge with all the tools I have in my technical arsenal, even if I do some wild stuff. And if that stands true, then we know our evidence is just that much stronger.
What do you come up with first? Do you come up with a hypothesis that gold's going to go up, and then you look for the technical data to support that, or do you look at the data first?
Data first. You can't start with an end result in your mind. That's completely the wrong. As a scientist, I kind of know that through my training. You don't sort of start with a supposition. You start right down at the basics with the evidence. You build the picture of what's actually going on. You look for the correlations. You look for the moving parts. What's causing that to move? What's causing that to move? What happens when that does that and this does that and that does that? Then you bring it all together, and then you start to get this confidence level that builds up. Sometimes, a bit like a weather forecast. We're forecasting a storm. It's going to hit Florida. What track is it going to take? All these computer models, they're all giving slightly different answers. That means your confidence level is quite low. If all of the computer models are giving the same answer, your confidence level is high. And that's to do with chaos in the atmosphere. It's the same as the markets. The markets have chaos. Sometimes there's lots of chaos. We call it volatility. When there's a lot of that, then your confidence levels come down. As volatility decreases and the path becomes clearer, your confidence levels go up. So you have to be able to clearly identify, your confidence level. You can't just come out with a forecast, a prediction, and say that's what's going to happen. That I'm not listening to anybody else. Anybody challenges me on Twitter, they're wrong.
Right.
That's not the way to go, because they might be right. There are lots of other possibilities, and you have to always keep that in mind. And and just try and follow the most likely outcome and keep your mind clear and keep this sort of ability to constantly change your views as well, because as time goes by, stuff changes. It's not us changing our mind, it's us taking new evidence into consideration. And you have to do that. As a scientist, you have to do that. And as a chart technician, you have to do that.
Patrick, I'll let you close off the conversation.
I totally forgot the question, David.
Sorry, I do that to Pat.
The evidence first. Yes. Well,
Yeah.
yes, exactly. It's always, it starts, guys, because the thing is, that's a lesson I learned a while back. I played some stocks when I was younger based on fundamentals or whatever. I read a story that hit. And then when the stock went in my direction, and that was actually bad for me. I should have got killed. It went up. And years later, I realized that what I thought was moving the price was something totally different. It was actually capital flows going in growth stocks, but I didn't know about the SPX to PPI chart back then, right? And even today, there might be something I don't know. I'll discover in 5 years. Oh, Patrick, it was finally with something else, a bigger asset classes clashing it out. So you try to get correlations from actual data. Forget the stories, because that's going to get you in a lot of trouble. You won't be able to accept. Let's say Bitcoin goes up in its basis, and I'm anti-Bitcoin. I want to play Bitcoin. I want to make money. So I can't think about those narratives. It's evidence first, chart price action first and foremost.
All right. Well, gentlemen, I thank you for your time today. Very enlightening talk. We covered everything, including how you trade, your philosophy, and of course your price outlooks for the important assets. Thank you for being on the show. Thank you for coming on Kitco. It's been a pleasure working for you or with you over the last year and a half. So thank you.
It was an honor.
It's been fantastic. Thanks a lot, David. Really appreciate it.
Okay.
Thanks, guys.
Thank you for watching Kitco News. I'm David Lin. Stay tuned for more, and don't forget to subscribe to our YouTube channel.